the biggest problem is in all this slow growth, recession, headwinds that we're seeing at the same time, debt keeps going up. And a lot, by the way. We're back to trillion-dollar deficits last seen in the early years of the Obama administration. Obama ran trillion-dollar deficits in 2009, 2010, 2011. Then they got it under control. In a manner of speaking, the deficits were still, $500 billion a year, approximately, order of magnitude. But that was down from $1 trillion. But now Trump is back to trillion-dollar deficits. And I make the point that this is really bipartisan. It's not a question of blaming Democrats or Republicans. It's bipartisan incompetence. But we're back to trillion-dollar deficits. And one of the things you have to ask yourself is, okay, is the deficit is the annual negative. It's basically the excess of spending over income. So you take in $3 trillion of taxes and you spend $4 trillion in the budget, you have a $1 trillion deficit. That's an annual concept. The debt is the accumulated debt, all the deficits since George Washington. And what's that number? The answer is today it's around $23 trillion. But it's going up $1 trillion a year. And you say, well, okay, is that high or low? You really can't think of debt and deficits in the abstract or just in relation to a number. You have to compare it to the income. And the way I explain that is, let's say you owe $25,000 on a MasterCard. Is that high or low? Well, the answer is it depends on your income. If you owe $25,000 on a MasterCard and your income is $20,000 a year, you're in trouble. You're probably headed for bankruptcy. But if you owe $25,000 on a MasterCard and you're making $300,000 a year, that's a comfortable debt level. You can probably just write a check and pay it off. So you can't decide whether a debt is a problem or not unless you look at the income. And the way to do that is take what's called the debt to GDP ratio, the GDP, gross domestic product. So how much debt does the United States have? Divide it by what's the gross domestic product. And look at that ratio, and that'll tell you if the debt is comfortable or out of control. So a comfortable level.
Is there a historic ratio that generally economies end up having a depression or a recession in?
Well, it's a funny thing. A depression can actually make the debt to GDP ratio go down because your growth is so. Actually, I misspoke. Make it go up because your growth is so low. Because you've got a numerator and a denominator in the fraction. The numerator is the debt, and the denominator is the GDP. So if your GDP is declining, which it does in a depression or it can in a depression, your ratio could actually be going up, not because your debt's going up, but because your economy is going down. We're in the opposite situation. The economy is growing. It's not growing very strongly. This is the weakest recovery, at least since World War II, possibly longer, or the end of World War II, possibly longer. But the debt is going up a lot faster than the economy is growing, so that ratio is going up. So if you said, what's a comfortable ratio? 30%, very comfortable. Any developed economy with a growing economy and with a 30% debt to GDP ratio, that's fine. 60% gets to be a little bit of a red flag, and that's where Angela Merkel is trying to keep Europe. She under the Maastricht Treaty. That's the treaty that forms the European Monetary Zone, the euro, the countries that belong to the euro. She's trying to keep that below 60%. But there's another threshold, which is 90%. 90% is in the danger zone. That's the real red zone. And what happens, this is based on research by Ken Rogoff and Carmen Reinhart, two very prominent economists at Harvard University, but both in their book, This Time It's Different, and also in a number of papers they published, which are publicly available. And I put all this in my book, my new book, Aftermath, so you'll find all the citations there. But they say at 90% or above, the debt itself slows down the growth. Now, the theory of government debt, this comes from John Maynard Keynes in the 1920s and 1930s. He said there are times when a country is in a liquidity trap. Liquidity trap just means people don't want to spend for whatever reason. They're fearful. They're worried about the stock market, et cetera. They don't want to spend money. They don't want to borrow. The banks don't want to lend. People just want to save their money. It's called hoarding. Well, how do you run the economy if nobody's spending and everybody's saving? Well, Keynes' theory was, well, the government can step in. The government can run deficits. The government can spend money. that will increase what's called aggregate demand. And little by little, you get the economy moving. And so if the government borrows $1 and spends $1, you might get $1.50 of GDP. Well, how do you get more GDP than the money you spent? Well, the answer is the money turns over. So I'm the government, I hire somebody to do something for me. That person gets paid, but then that person goes out and spends the money on a subcontractor, and that person spends the money, takes the spouse out to dinner, whatever, and then that's called velocity, which is the turnover of money. So when you're starting on a low level, you're coming out of a recession, you're in a recession or in a depression, you're in a liquidity trap, and you spend a little bit of money, you can actually get more GDP than the amount you borrowed, and sometimes it can be a lot more. You can borrow and spend $1 and get $1.50 of GDP. Well, that's good because your economy is growing faster than your debt. But there are limits to that. And the limits are it works better early in an expansion or in a recession. It works better when you don't have too much debt to begin with. It works better when you have a lot of excess capacity that can actually be put to use, meaning a lot of unemployed people who can come back to the workforce, unused industrial capacity that can be expanded. So those are the conditions under which this, what's called the multiplier, getting more than $1 worth for $1 spent, works. Today, we're in the opposite of all those conditions. We're not in a recession. We're in the 11th year of an expansion. We don't have a low debt to GDP ratio. We have a very high debt to GDP ratio. We don't have a lot of slack in unemployment. Unemployment is the lowest in 50 years. It's 3.7% or 3.6%, the lowest since 1969. So none of the conditions that Keynes outlined to say, well, here's where you can get some bang for the buck, apply. And what Rogoff and Reinhardt point out is that when you get above 90% debt to GDP ratio.
What are we? We're at about 120. Is that what you said?
We're at 106.
106.
Going up a couple points a year. It'll be 107 next year, 108. The highest since World War II. By the way, World War II was 120. That was the all-time high. But
okay.
I make the point, well, yeah, but we fought World War II. We won. So we had 50% of global output. So you got something for the money. And this put the U.S. in a global hegemonic position. So, yeah. And by the way, between 1945 and 1980, that debt to GDP ratio was whittled down from 120% to 30%. Now, it took 35 years, and Republicans and Democrats, it was Harry Truman and John Kennedy and Lyndon Johnson and Jimmy Carter for the Democrats, and you had Dwight Eisenhower and Richard Nixon and Gerald Ford for the Republicans. So both parties worked on this together. The Fed and the Treasury, the country as a whole kind of came together, and we got that debt to GDP ratio down from 120% to 30%, which is
And what are the genuine consequences of this increasing ratio where someone might say, okay, well, obviously their plan is just to basically close their eyes and keep printing more and more and keep ignoring it. What are the actual consequences for someone that may kind of understand the things that you're saying, but when you break it down to the most simplistic term and you say, as our debt is continuing to increase and our GDP is starting to slow and global GDP is starting to slow, what are the actual consequences of that for you and I and someone listening that is like, I'm not an economist, I'm an entrepreneur, I don't really pay any attention to that, I'm just focusing on making more money. What are the consequences of this?
Well, the main consequence is slower growth. In other words, instead of more debt being an engine of growth, more debt becomes a headwind to growth. It slows down the growth. Now, think about that for a second. So I said, at low levels of debt and a lot of unused capacity, you can spend $1 and get $1.50. That's pretty good. That's a good payoff for $1. Today, we're in a world where you spend $1 and you only get 90 cents. You don't even get the $1 back.
Got it.
So that's a headwind to growth. Why is that a headwind to growth? Because people aren't stupid. They look at the situation, as you say, Jake, they may not be economists, and you don't have to be, but you say, well, wait a second, this debt looks like it's out of control. Something's going to happen in the future. Either there's going to be a default, which is unlikely because we can print the money, but it's something you put on your list, or they're going to tax me more. Like, how are we going to get out of this? Well, I'm going to have to pay higher taxes. So I better save more today to get ready for those taxes coming down the road.
And that's
Uh,
how I feel right now. I feel like trying to take advantage of this right now as much as possible.
Yeah. And then the third thing is it's non-sustainable. You could have a credit crisis. So there are a whole set of bad things that could happen. A credit crisis is one. Default, not that likely, but possible. Higher taxes, definitely possible. And if growth slows enough, you get into a recession. Now, what are we talking about? Lost sales, higher unemployment, losing your job, defaulting on your mortgage. All the things that we saw in 2007, 2008 will come back because of this debt problem. So that's the situation we're in. Now, a lot of people think, well, you know, George Washington came in 1789. There was no debt, and it's been going up ever since, and now we're at $23 trillion. That is not what happened. First of all, when George Washington became president in 1789, we already had debt. We had national debt before we were a nation. It was debt left over from the Revolutionary War.
You want to do a quick quiz? I think I remember from your book that what is it? 80% of the debt that we have right now has come in the last, what was it? What did you say? 14 years?
Well, the last 20 years.
Last 20. Okay.
Yeah, it is 80%. I mean, just to kind of cut to that for a second, when Bill Clinton left office in 2001, January 2001, the national debt was $5 trillion. George W. Bush doubled it from 5 trillion to 10 trillion. Obama doubled it again from 10 trillion to 20 trillion. And then Trump has added a couple trillion since then. So in other words, 19 years ago, or not even 20 years ago, the debt was 5 trillion. Today it's 23 trillion.
Okay.
So what's 18 divided by 23? It's over 75% of the debt has come in just in the last 19 years. So, and that breaks a pattern, and I talk about this in my book, Aftermath. Again, going back to George Washington, debt didn't go straight up for 200 years or 230 years. It went up and down and up and down. It was a sine wave. Well, what caused it to go up? Well, the answer is war. It went up during the War of 1812, the Mexican-American War of 1848, obviously the Civil War, the Spanish-American War, World War I, World War II. Those are times when the debt went up. When did it go down? In times of peace. So after the war was over and the U.S., pretty much always won, then you would grow the economy and pay down the debt and not borrow as much and even run surpluses. A lot of presidents forget about deficits. They ran surpluses. Calvin Coolidge, Warren Harding, even Richard Nixon, even Bill Clinton had a couple of years of surplus. So the idea is debt goes up in time of war. It comes down in time of peace. And overall, it stays within bounds and it stays manageable. And as I say, as recently as 1980, it was only 30%. What changed, beginning with George W. Bush, but continuing through Obama and Trump, and again, I think it's important to make the point, this is bipartisan. This is not Democrat versus Republican. This is, I would say, globalists versus nationalists, or elites versus people more in touch with the American people. Suddenly, okay, so Bush had 9/11, that requires some money, but Iraq was a war of choice. We didn't have to go into Iraq. Obama did not have any new wars. Trump has not had any new wars. So based on this historic pattern that goes back 230 years, what we should have seen in the last 10 years, let's say, is the debt to GDP going down.
Okay. So the concerning thing is that it's went up while we've been in peace.
Correct. That was the pattern that prevailed for 230 years is broken. Now, it didn't go straight up for 230 years, but it is going straight up now. So we used to have bipartisan responsibility. Now we have bipartisan irresponsibility. And so then with that as the background, that flies right into the research of Reinhart and Rogoff. It says, oh, by the way, when your debt gets to that level, and today we're at 106%, way past the 90%. They identify 90% as the place where you cannot borrow your way out of the problem. Up until then, you can borrow, get some growth, grow the economy faster, pay it back, make it sustainable. People always say, well, you can't pay off the national debt. Well, you don't have to pay off the national debt. What you do have to do is roll it over. In other words, you need to maintain the confidence of the markets. You can borrow new money to pay off the old money and keep doing that provided that creditors view you as creditworthy, provided creditors, investors basically think that you're managing it in a responsible way. And this was the great insight of Alexander Hamilton. You know, Alexander Hamilton is this, you know, liberal progressive hero because there's this Broadway musical, and I guess he comes off okay in the musical. But in real life, what he did when George Washington came in, Alexander Hamilton was Secretary of the Treasury, and they said, what do we do with this Revolutionary War debt? We can't pay it. And the Congress said, well, that's easy, just default. You know, it's the American way, just don't pay it. And Hamilton said, no, let's borrow more money and pay it off. This will establish our credit, will be creditworthy, and then we can borrow even more money and pay off the first borrowing, and then borrow more money and pay off the second borrowing, and so on. This was the creation of the formation of the U.S. government bond market. This is when it started. And Hamilton's insight was, you can always, if you're creditworthy, you can always borrow new money to pay off the old money and just keep it going. And it has been going for, as I say, over 230 years. But there's a condition on that. The condition is that you have to manage it responsibly. You can't let the debt to GDP ratio get out of control. And for times when you're borrowing more, there has to be some other time when you're borrowing less and paying it off and keeping that ratio in line. That was Hamilton's great insight. It has worked well. He was right. So you don't have to pay it off, but you have to make it sustainable so you can roll it over. The problem today is we've run off the rails. We're not paying it off. We're not reducing the debt to GDP ratio. We're not acting responsibly. And we're getting closer to the point where both U.S. citizens and global investors are going to say, you know what? I don't know what's going on here, but get me out of here. Get me out of the dollar. Get me gold, silver, land, natural resources. I'll buy a new car, a new refrigerator, buy a house. I'll I'll do something. But I got to get out of the dollar and these bond markets because I don't trust the ability of the United States to manage this. That's when you have your debt crisis. So if you say to me, what are the problems of this? Number one, the debt itself impedes growth, so you cannot grow your way out of the debt as we have been doing since Alexander Hamilton. You can't do it. Number two, people see this happening and it actually gets worse. They start to save more and spend less, so that's another headwind to the economy. Or three, they ditch the dollar completely, get into hard assets, then you have a credit crisis. Or four, the Fed says, well, why don't we just get some inflation and make the debt go away? The thing with inflation, it's like watching an ice cube melt in your hand. You know, if you hold it there long enough, it goes away. If you have enough inflation, the debt is still there in terms of dollars, what they call nominal debt. It's still there, but it doesn't cost you as much. It's like saying to China, hey, we owe you $1 trillion, print it up, fly it over there. Here's your $1 trillion. Good luck buying a loaf of bread. In other words, we make the debt go away the way you make an ice cube melt. You just inflate it away.
Right. That's
the American way. The problem with that, I'll finish quickly, the problem with that is the Fed's been trying to get inflation for 10 years and they can't do it. Like I say, it's a sad day when a central bank wants inflation and can't get it. They should be able to get it, but they can't because they don't understand inflation and where it comes from. But so if you can't grow your way out and there's no need to default because you can print the money and you can't get the inflation, what do? Well, the answer is you just keep going down the road and increasing the debt to GDP ratio until you have a credit crisis. So I can't say exactly what will happen, but I can say it will be one of several things, and they're all bad.